Okay, let's talk about something that's probably been on your mind. If you've looked at the cost of a mortgage, a car loan, or even just your credit card bill lately, you have definitely felt it. Interest rates are high, and the big question everyone's asking is, when are they finally going to come down? Well, in this explainer, we're going to dive into a new reality. They might be staying high for a lot longer than any of us think.
Seriously, this is the question, right? We've all been feeling the pinch. Getting a loan for a house or a car feels way more expensive, and that credit card balance just stings a little bit more. So when are we going to get some relief? Let's just get straight to it.
So if you're holding your breath for a big rate drop, you can probably go ahead and exhale. The most direct answer we have right now is it's not happening anytime soon. And look, that's not just a guess. This message is coming straight from the top, from the world's most powerful central banks. Let's break down exactly what they're saying.
First up, let's take a trip over to Europe. The European Central Bank, you'll hear it called the ECB, is a huge player in the global economy. And right now, their message on interest rates, it is crystal clear.
You know, what's really wild about this statement is just how blunt it is. In the world of finance, you usually get this super careful, vague language. But not here. Top officials at the ECB have come right out and said there is no rush to cut rates. That is about as direct a signal as you can possibly get.
And they're not just talking the talk. Their own plans, their own projections show rates staying right where they are all the way through 2026. This tells you what their priority is. And it isn't necessarily making loans cheaper for us right now. It's about making sure the whole economy stays on solid ground, even if that means we're stuck with higher borrowing costs for a while.
Okay, so that's the situation in Europe. They're holding firm. But what about here in the United States? Let's turn our attention to the U.S. Federal Reserve, or as you probably know it, the Fed. And you guessed it, it's a very similar story. The Fed is also being super cautious. The key phrase that keeps popping up in their recent reports is that some of the most important people making these decisions are still hesitant. They're really worried that if they cut rates too early, it could just undo all the hard work they've done fighting inflation.
So you've got Europe saying no rush, and America saying they're hesitant. This is no coincidence. What we're actually seeing is these two financial giants basically moving in lockstep, and that is creating a really powerful global trend.
And this slide just lays it all out perfectly. On one side, you've got the ECB's firm stance, totally focused on stability. On the other, you have the Fed's cautious approach, focused on weighing all the risks. I mean, they're using slightly different words, but come on, they're singing the exact same song. We are not cutting rates anytime soon.
This brings us to a really important term for what's happening right now: rate cut caution. This isn't some accident. It is a deliberate global strategy. The world's biggest banks are all hitting the pause button together because they've decided the risk of cutting rates too soon is way worse than the pain of making us wait.
Okay, so we've established this global trend of caution. But what does all this actually mean for your wallet, for your plans over the next few years? Let's get to the big takeaway.
This timeline really puts it all into perspective. Forget thinking this is just a short-term thing. We've got high rates basically confirmed for 2025. Projections show them holding steady into 2026. And now we're even getting signals that this environment could stretch all the way into 2027. We are officially living in the higher for longer world, and this is what it looks like.
So look, if you take just one thing away from all of this today, let it be this. This era of high interest rates isn't a short sprint that's going to be over in a couple of months. It's really, truly shaping up to be a long-distance marathon.
And that leaves all of us with a really important question to think about. Knowing that these high borrowing costs could be our reality for the next 2, maybe 3 years, how does that change your plan? You know, for your savings, for any big purchases you were thinking about, for your investments. That's the new reality we all need to start preparing for. Thanks for tuning in to this explainer.